Welcome to the NDR Signal Exchange. This is Ned Davis, and I'm very interested right now watching foreign investors in the U.S. stock market. This is related to all the talk about tariffs. It seems to be the biggest subject going on right now, and NDR has an enormous amount of data on all kinds of investors. We want to see their supply and demand situation for U.S. stocks, and I thought by going through a few of these, we might give some perspective on this supply and demand balance. First thing I want to say is that, I do believe we need to do something about our trade deficit. National security is threatened when much of what we need and buy is produced overseas. But there have been some positives besides cheaper goods because of the trade deficit. Foreigners sell us goods and we send them dollars. A lot of these dollars get reinvested back into the U.S. stock and bond markets. In fact, with trade deficits near record highs, the holdings of U.S. stock by foreigners is now the highest since the major market top in 1968, as can be seen on the chart there, S481, the first chart. It's now at 31% of their holdings are in our stock market of all their financial assets. These holdings are well above the long-term norm of 19%, or it was just 12% at the bottom, secular bottom in 2009. If foreigners were a small group, that would be one thing. But in fact, foreigners own 18% of the U.S. market. That is actually understated because we show total market cap on this chart at 93 trillion, when in fact listed the actual stocks that trade on the exchanges is under 60 trillion. So foreigners are a big deal in the supply and demand balance for U.S. stocks, and they have been huge buyers. We had record inflows into stocks around the election of President Trump last year. But what caught my eye in January of this year, we saw, admittedly, it was slight. We saw slight selling of $11 billion based on the preliminary data. That may be a key signal to watch. Why might this matter? Why would foreigners quit buying or even sell? If the tariffs cause their sales to the U.S. to plummet, then they will have less dollars to reinvest in the U.S. Of course, Trump hopes they just open plants in the U.S. where they can produce with no tariffs. On the other hand, it is also possible to speculate that the massive inflows of repatriated dollars back into the U.S. helped cause the recent bull market in stocks, and along with that, because they put them back into dollars, a rising dollar, which was a double boost for foreign investment over a number of years, and they have taken great advantage of that over many years. Trump threats towards our allies like Canada, Mexico, and the European Union could cause, say, less vacationers to come to the U.S. to spend money. Conceivably, foreigners could turn anti-U.S. where they don't even want to buy American products. Both of these could even hurt our trade deficit, not help. The worst possible solution would be a trade war where both sides try to protect themselves. This would raise prices and hurt growth, so-called stagflation that has historically led to poor returns from stocks. Such concerns have caused the Fed recently to cut growth predictions and raise inflation concerns. NDR chart E100E shows the historical returns of stagflation in the bottom right clip. Right now, we're in a slow growth, low inflation environment, which is pretty good. But right below that is stagflation, where stocks suffer. Anyway, I hope these charts help put the current tariff concerns into a useful perspective. If you have any more questions about this or any other subjects, just send them to Ned Davis Research at ndr.com. Thank you.